Now we talk about our investing framework. So obviously we are in a way this keeps evolving, except for the philosophy part, because that doesn't change, but the process does evolve. So in line with whatever we have learned in the last 2-3 years and beyond. So all those things are included here. So now coming to our framework, it is based on two legs. One is the fundamental research, and the other one is behavioral finance. So fundamental research is entirely aimed at estimating the fair value of a stock. So whatever we do is somehow designed to try and estimate what is this stock worth that we are considering, right? And then we pick those stocks where the gap between fair value and the stock price is sizable. Then we say that, okay, this is worth considering further. And the research is based on a mix of by dovetailing narratives and numbers, stories and numbers. So stories around, say, sustainable competitive advantages, say, good corporate governance, and the vision and ability of the management. And then we club it with the numbers that we are able to forecast around growth for revenue and earnings, balance sheet, and the change that is happening from a improvement perspective, or maybe high return ratios or improving return ratios. So all these are aligned to come up with an estimate for a fair value of a stock. Now, as a part of this only, we also have a portfolio construction process that is helping us in diversifying the risks. We call it FACTS, as you can see in the bottom box. So FACTS box portfolio construction process, we call it as. So basically FACTS, these stand for 5 baskets. F stands for fast growers. So basically these companies are likely to double their earnings in the next 3 to 4 years. So around 20-25% per annum growth is what we expect from that. And typically these are small and mid caps, not in the radar of most of the investors. Very few people know about them, at least not the institutional investors. So the potential for upside can be quite high here, but only one has to be very cautious about the corporate governance and all those issues. So similarly, we have asset plays, A, C for cyclicals, T for turnarounds, and S for stalwarts. So all these 5 baskets, we have pre-assigned ranges of exposure in our portfolio. So we don't exceed or go below those ranges. For example, fast grower bucket in our value for growth approach is supposed to be between 45% and 60%. So we don't exceed 60, we don't put below 45. So basically, even if it's a good stock in that particular category, if that category is already exhausted, we won't be able to take that stock. Now, what does this process do to our to our portfolio? This is what we are able to achieve. So basically, if you see, these are 3 parameters to judge the portfolio for its future prospects. So one is the valuation, price to earning on the left hand side. Then you have growth in earnings, that is profit after tax growth in the middle, and then you have return on equity. So if you see, it is very well dispersed. So this is what we want to achieve for our portfolio, and this is what we are able to do with our FACTS box process, portfolio construction process. And that's why we are fairly confident, even in a falling market, we'll be able to outperform the market without taking cash calls.